Welcome everyone to our Strategy Asset Managers quarterly update. Today is Thursday, July 16th. The time is 11 o'clock, and we are going to start our call. I want to remind everybody that who's on the call. This is a new format that we have, and we don't have the ability to ask questions and integrate like we have done in the past. But questions can be sent in that we can follow up on. With me on the call today is my partner, Joe Traba, who is our Chief Investment Officer and our Senior Portfolio Manager, and also a partner, Alex Hagstrom. He's our CFA. And we are delighted to be here to express some optimism for the second half of the year. The title of the presentation today is going to be Data Over Emotion. We are sending out our Strategy Asset Managers Mid-Year 2026 Investment Outlook shortly. We will be highlighting the strong performance that we've seen in the first half of the year. Not following the mainstream, but taking profits as any active manager should do, finding opportunities and really just staying humble because it is such a competitive landscape out there. I wanted to highlight a few things before Joe launches in and just give you a high-level review. We've had a record-breaking rebound in the stock market. The markets were negative after Q1, but they've rebounded, led by momentum. There is a market concentration, and the market is at all-time highs right now. But Sam really stuck to its discipline and took some profits off the table, which is what you want to see with an active manager. We want to take some time to highlight that the outperformance this year is significant, and we want to talk a little bit about that, especially with the market-oriented portfolio and our worldwide dividend portfolios. But the main thing that Joe is going to highlight is that the primary driver of this expansion in the market are earnings and the growth rate of earnings. I'm going to turn it over to Joe, and then I'm going to also step in to ask questions along the way and prompt several discussion points that we have for the group. Call should be about 30 minutes, and welcome to our call. Joe?
Yeah, thank you, Tom, and thank you everyone for joining us. We're very excited with our past performance, but we're also excited for what we see as opportunities for the second half of the year. And like Tom mentioned, we're going to review a few items, go over some of the major developments that we see, and some things that we think you should focus in on, and obviously go over some of the risks as we plan out the balance of this year, but also for next year. And as we started, anytime we look forward, we like to look backwards. And the first quarter, if everyone remembers, we had a 9% drop in the markets. And, there was a lot of headline news that was out there. And that's one part of having someone that you can talk to and to kind of go over what you should be doing. And that temporary drawdown was obviously erased. And we had a record rebound in the second quarter, specifically in the month of June. And what we've always mentioned is, don't get emotional and really stick to the fundamentals and stick to the work that we're seeing. And earnings are growing 20%. So remember, back in December, they've raised earnings by over 10% for this year. Next year, we're expecting about a 20% gain in earnings as well. That is what drives the markets long term. And we're continuing to see earnings revisions higher. That's good news. We'll go over some of the concentration risk that we're seeing, but just to kind of go over the high level of where our optimism lies, it's in that. And it's also looking at the infrastructure. So how we positioned our portfolios is to take advantage of some of those themes. And it's also a rotation that we're seeing now, and we'll get into that in a bit. But really looking forward and not just sharing what we've done as active managers, but it's also a fun part where we've been fortunate to work with people for over 20 years, where we're seeing children now no longer a child, no longer in college, but out in the workforce. And that was done by successful planning. We also have people that are now retired and have been retired and going on these extra beautiful trips. We love hearing that. That's part of what our job is. And these are good things to share. So we'd like to congratulate everyone that's going on vacations or having children or grandchildren getting through college. That's part of the financial planning that we provide as well. And that's a big part of, how we manage money as well. Now, getting back to the stock market, we belabored the point with earnings, the primary driver, and then the growth rates. But what sectors really benefited from? And
Yeah, and it was semiconductor and optical component manufacturers because these are the direct beneficiaries of data center construction. We've talked about trillions of dollars of investment coming in. Those trillions of dollars, they are going directly into the profits for these semiconductor companies, for these optical component manufacturers, and they've exploded higher both in stock price and earnings, and they have years of runway so long as this capex continues.
yeah, and a real good part on that, and I don't know if people know this, but we always talk about how many data centers are based in the United States. It's about 50% in the United States. And what state? Virginia. So Virginia is kind of the hub of data centers for the world. And we mention that because that's an opportunity going global, where we continue to see the demand continuing to rise, not just for data centers, but also for power, electricity. So those are two big themes that we've, been on and how the portfolios are positioned. It's not just the AI, but you have to have the power, so the electrical components, and that still we think has a large runway, and it also has bipartisan support. Alex, we talk about the different public-private ventures. Do you want to mention a few of them that we spoke about?
Yeah, I think most notably in nuclear, where the government recently earmarked almost 20 billion in loans to jumpstart the construction of new nuclear reactors. And this is just an incredible positive step for America. If you look back just a few years ago, the country had given up on new nuclear reactors. There was never going to be another reactor built ever. Now we've completely turned it around. We could look forward to potentially a nuclear renaissance. We all know electricity prices are a serious issue. They've been rising fairly significantly over the past few years, but a nuclear renaissance, a bunch of new nuclear reactors, that could help those prices to stabilize and eventually even fall, and of course, to power the AI revolution.
Yeah, and that's a big part of when we look at investment themes, it's nice to have the support of following the money. If the government is going to back something, we were early adopters into this, that's usually a good place to be. And then you're seeing a Microsoft coming with a joint venture with Chevron. And then we'll go to a few more deals that have been mentioned. But that's a powerful trend that we see going forward. Another part of that, when we look at earnings, it's which companies are able to raise prices. And as we get into the fall or the end of summer into fall, Microsoft and Apple both have raised prices. So anyone looking for a new iPad or a new phone, expect, I think, around a 20% increase in that price. So for us, successful companies are able to raise prices and that helps their margins. It's not good for the end consumer because we're going to pay a higher price, but if it's a necessity, something that we do need, we will pay up for it. And I think that's the next tailwind for this market. It's how to monetize AI. And that's just a loose term that we're using. But you've seen the semiconductors, the first wave of demand, and now what will be that second wave? And that's always looking forward for the next item of where we see opportunity. So that's one place to look at. And that's, again, some things that we see. Now, as we position for the second half of the year, we'll go over some positives and obviously we'll go over some of the negatives. Some of the positive, we have mentioned the 20% earnings for this year and next year. And we just had a few companies report this week. We'll have Netflix and Intuitive Surgical after the close. and then the following week Google, and then really in 2 weeks it's a bonanza of earnings. But why we're optimistic so far, the banks, and now banks don't need to lead the market, and they've been relatively flat, but they had really good numbers, and that's important because that's lending. And if we have lending happening and the banks capitalizing on it, that's a good positive for the stock market. And they all did report some good, impressive earnings. It's a few different tailwinds. It's not just credit cards, which we've seen, but they all passed their regulations and were able to increase the dividends. So that's also a positive sign of cash flow. But it's also the wealth management side that's doing well. So you have a number of different, and the investment banking with some of the IPOs that have come out and that are coming out. Alex, did you want to mention Johnson and Johnson?
I did. So we've obviously spoken about the semiconductors, which are leading, but there are other companies outside of that putting up very impressive growth. J&J, which is a core holding for us in several strategies, is growing quickly and it's going to soon breach 100 billion in annual revenues. And as we always say, earnings drive the stock market. The stock's up around 60% in the last year, thanks to that incredibly strong earnings growth.
Yeah, and then as we get into just a couple of stocks that, we see going forward, it's Tom and I were talking about insurance, another favorite topic over here. And the beauty of insurance brokers are they're able to keep raising prices. So there have been some events that happened, and now our premiums are coming due for anyone that has insurance, whether it be medical or anything on the business side. You'll see your premiums are all higher. That's usually a good business to be in. They don't have the risk involved with what they're insuring, but they're going to charge a higher premium. So I do think after a lot of these events that we've had, premiums will be higher. And if we don't get, any other catastrophic events occurring, these are going to be good for those financials. So just a couple of pockets that we see going forward with some room to run. Another part that we've continued to talk about is how resilient the job market and the economy's been. So for a positive catalyst going forward, if we have GDP above 2%, we have an accommodative Fed, meaning, and we'll get into a Warsh with the new Fed chair and some of our outlook there, combined with an administration that is pro-business. All of these are powerful tailwinds for the stock market. Alex, did you want to go in a little bit about our new Fed chair?
Yeah, we are very positive on the new Fed chair. He started to put his stamp on the central bank. He's very data driven and he's pursuing what I would call is a much more honest approach. We've seen very clearly over the past few decades that the Fed is not capable of accurately forecasting the economy. And their reliance on these bad forecasts has led to a lot of mistakes before COVID, after COVID. Warsh is admitting that this is a reality. They cannot forecast well, and he wants to rely on data as it comes in. He wants to not anchor on those predictions, which have proven to be wrong. And I think that, as well as a lot of other changes, are going to be incredibly positive for the institution, which does need to improve. It's not been doing very well, and he is a great step in the right direction.
I kind of look at the government as the DMV. If there's ever a place that needs to be revamped with, I wouldn't even call it AI, just technology. These are great places to go. So, just some things anecdotally when we see opportunities and not just looking at what we do, but other sectors as well. And that kind of leads me to one positive element that we've spoken about here and actually have watched is the World Cup. Now, why would I mention the World Cup? This is just incredible to see the reaction from visitors around the world coming to our country, but it's also how accommodative we've been as Americans. And this really showcases what a great country we have, what, America is all about. And it's not just the large cities, not just Los Angeles, New York. You're seeing the smaller cities And it's just been overwhelming. This is just any media that gets posted, and it's all the media that's posted. And it is so overwhelmingly positive. I mean, for me as an American, that makes me, feels good about what we're doing here and what we have. And looking at some of the purchases, some of the things we just take for granted. Now, I'm not a big fan of ranch dressing. That's more Tom's avenue. But hearing Walmart, Costco can't have enough ranch dressing on their shelves, these are just fun things to see. And again, just things that we take for granted, that the abundance of not just food, opportunity, and beautiful places to go, and sharing that with the rest of the world. So again, just something to feel good about or what we do have, and kind of a showcase for the world of what America is. Now, living in LA, I kind of look forward to 2 years. What do we have coming up? The Olympics. And just having one event that caused this much traffic, I hope that we will be able to get some of our transportation cleaner, and we don't have some of the gridlock that is anticipated. Or I'm going to be working remotely from a different country. But again, just sharing some positive things that we see. Now, not everything is beautiful. What are some of our negatives? Obviously, as we look forward, we do have midterm elections, and we also have, again, the second half of the year with geopolitical concerns. That hasn't gone away, that just reemerges. We still have inflation pressures that are out there. And we still have, for us, what we're really nervous about is just looking at the debt financing. And what I mean by that, it's the lending. Now, when I go back to our government, both sides of the aisle are in unison with not addressing, balancing, let alone reducing our budget and our budget deficit. That, in the long term, will have to get addressed. We're not there yet. Both sides agree to kick the can down the road. But as we see that, again, that's a supportive administration for spending. This happens until it doesn't happen anymore. And when we look at the CapEx that Alex mentioned with a lot of the large AI or hyperscalers, what gets us nervous is the funding for it. Once you start getting into some, not just issuing a bond, but debt refinancing or debt financing, those are some things that get us nervous. Now, we're not there yet, but I'm just letting people know what are some of the things that, are getting us nervous and what we're keeping track of. So I did want to share that with you. Um, Again, it's the other part with AI, which is completely revolutionizing, how we do things, how we operate, how we see things going forward. And there's a couple of read-throughs from that. It's not just, I always talk about a Waymo. Everyone should have driven in a Waymo, but now it's getting more into what you can do, talking and having everything that you want to do planned out for you. And a perfect example is travel. I don't know how many people have used AI to book a vacation, but I highly recommend at least looking at it. It gives you some great ideas, places to go, hotels, those types of services that are available and are just going to get even more transformed are pretty amazing. And it does help us because we don't have to spend a lot of time to do this. And then you have a great, vacation potentially coming on board. So just kind of think of like that and then how to monetize it. That's where we look at the next phase. Now, we do expect the volatility with the Fed and the government policy. Alex, did you want to touch on the midterm elections?
So typically, the midterm elections and really elections in general in the United States haven't really affected stock market returns. Whether you look at Democrat administrations, Republican administrations, the stock market has trended upwards over time. And again, this goes back to earnings, right? Midterm elections aren't going to make earnings growth fall from 25 to 0, regardless of the outcome. So the core secular driver of the bull market is going to be intact no matter what happens.
Yeah, so we do expect, again, looking at some of the incredible returns in the month of June, a little bit of a cooling off. Things can't just go straight up. And we're witnessing right now some of the semiconductors that were up, 70, 80% in a month, up, maybe a couple of them 100%, some even 1,000% for the year. It's healthy for the market to see a rotation, and that's taking profits off the table and also going into some other areas of the market. And we've mentioned a couple of them that did not participate, that are seeing rotation into it. And how we look at that is the equal weight versus market cap, meaning looking at the market right now, and it's about 40% of the S&P 500 is in technology. We're really skewed to 10 large companies. When you have a passive fund, you're going to have an over concentration in those companies. And if we continue to see this rotation, you're going to be stuck with a lot of these larger companies that are getting sold off. And again, that's part of what we do as active management. And like Tom mentioned, we did take profits and a couple times in some of the names earlier this year. And again, that's just prudent for what we do and rotating into other areas of the market. And that's what we're seeing right now. So it's important to know what the rotation is. Could we see a 5% pullback? Yes. After the market being up, double digits this year, and some of our portfolios up more than that, we're excited with how we've done. But also you have to look forward, and after that kind of rise, don't be afraid to see a 5% pullback, which we typically get twice a year. And having a little bit of history knowledge, I think, is a good thing. This is just a tidbit. Alex doesn't like when I bring these tidbits up, but I think it's worth mentioning. Uh, when you have a market that had a very strong return in the first half of the year, it does position itself to continue to have a good year. So what I'm saying by that was when the market's making all-time highs, it has a tendency of approximately 80% to continue to have a positive return in the second half. Doesn't mean that you're not going to have pullbacks, but it just means where you end up and that momentum can continue. And it's a positive sign to see the rotation out of one area into the other area. So those are some areas that get us positive, not just with the market performance, but what we're seeing with the next phase of AI and how we can capitalize on this as consumers. And what does that mean for us? So we do see a lot of positives. We do see some yellow signs that are out there that we're paying attention to. But again, as our outlook looks backwards before we can look forward, these are some of the tailwinds that we have right now. And again, some of the opportunities. My last point is with the consumer, as we've seen higher prices and inflation, and not just oil being higher, but anyone going shopping, going to a restaurant, your prices are substantially higher. We talked about insurance, we talked about utilities. All of these have gone higher. Now, what if we do get energy back below 70, the price of oil? That's going to be a pretty, powerful bonus to the consumer. It's also the what if we do get some tariff relief, which Walmart said they are, and they're lowering prices. So these are some positives that could help us as a consumer, but also be a tailwind for the stock market as well. So we do see, again, other positives as we look out to the second half, but also in 2027, of some things that we think could be catalysts going forward.
Joe, while we talk about the catalysts going forward, let's get a little bit more granular with the sectors that we've seen shifted into the second half of the year. Can you just talk about, with Alex as well, the sectors that will probably continue to lead us into the end of the year and into the next year?
Yeah, I mean, the first one is technology being such an overweight in the markets, and that's something that we're underweight. But technology continues to lead, and it's the secondary plays that we look at with the data center being built. What products need to build it? That's the industrials. So we definitely like the industrials, and all of our portfolios are overweight that area. The other part is the lending side, and that's financials, banks. These are boring areas, but if anyone has an account, a checking account and a savings account and a credit card account, you'll see that the banks are doing fine. They're making good money lending. And I think those are some areas that, again, continue to see this dispersion or broadening out. Another part that we've seen is small caps. And this is really interesting because when we do our data, it's still, Alex, what's the number of small caps that do not make money?
I think about half, just off the top of my head.
Half. That's half of the companies index don't make money, yet that index is up maybe around 18, 19% year to date. That's been a leader. And again, it's not looking backwards, it's looking forward, where we could start seeing some of these companies, and we call it the green shoots from in the United States of having new developments and projects being built. And it's the secondary plays of a data center being built. Now those people building it are staying in a hotel, going to a restaurant, and those are all spending that we see help the smaller economies or smaller companies. That's a positive. And another positive that doesn't get talked about, IPOs, initial public offerings. Now, SpaceX was the largest one on record. Alex, do you want to talk a little bit about
Yeah, I
SpaceX?
think it's often lost because of Elon Musk's personality, because of all the fanfare over the stock price. But SpaceX is really one of the most incredible revolutionary companies in the history of the world. And if you've never seen the Starship, which is their flagship rocket, I would encourage you to go on YouTube and check it out. It's absolutely incredible feat of engineering. And there was no space economy before SpaceX. It is essentially, I believe, 80% of the mass that goes into orbit. And in addition to that, the Starship runs off liquefied natural gas. Now, the US is the largest nat gas producer in the world. So if the space economy does develop as Elon Musk expects, which would be thousands of launches per year, then that will be another tailwind for natural gas, another tailwind for the United States, and just an incredible achievement. And alongside SpaceX, of course, we've got the other AI companies. We don't know exactly when Anthropic and OpenAI will IPO, but they do plan to do it soon. And those IPOs, they unlock tremendous wealth for the early investors. They allow essentially all of the employees become millionaires overnight. So that can be a boost for markets as well.
So the adaptation phase that we're going through in integrating AI into an everyday exercise is increasingly becoming a shorter pathway. Companies have been experiencing this AI bloom for a few years, and now this morning, Joe and I talked about what's next. What's next, Joe, and the downstream effect of that, and the improvements that will continue to take place in this business cycle.
Yeah, and it's twofold. Part of the cycle for technology, hardware has a tendency to outperform in the beginning, and then software can capitalize it on the second part. What is, I think, different happening now, software is not benefiting, and IBM, which we don't own in our managed accounts, was down 25% in one day. Software is getting hit by the open source or AI, for lack of a better word. It's making things easier to do and replacing some of the costs a business does spending on software. So that's one, potential negative. I think, it's a positive for businesses because they can no longer, be beholden to some of these companies that they pay a lot of money for. So that's an immediate trend we're seeing right now. But again, it's the secondary plays with the consumer. Does that make it easier for us to do something? And easier, I mean, does the cost become lower? I think it does. And that's one of the topics we discuss is AI, and is it inflationary or deflationary? And we think it is deflationary.
And capitalism in general, it thrives on this process of creative destruction. So, yeah, AI is going to cause a lot of companies to go bankrupt, but new companies will be born that do even more incredible things. And it's just a natural process of the economy. And that is how we progress. and move forward. Right now, of course, we don't know exactly which companies are going to be destroyed by AI and which are going to be elevated, but it will be for the best in the end.
Well, I think it also, in talking a big macro picture, if you think of what AI could do globally, countries that are not participating with the business cycles as quickly as we should have been, or they should have been over the last decade, have now been given accelerators to potentially participate. And then you look at larger countries. Let's just say the continent of Africa and all of the countries inside of there. They're given opportunities now to catch up. The same thing with India, the same thing with China. It's a race, but it also, the topic of being an accelerator, the accelerator aspect of it is fascinating, and that's what we can benefit from picking the right companies that will be participating with that.
Yeah,
Uh, Go ahead, Joe, because
yeah.
I'm gonna follow on with that.
And that's an exciting, I mean, that gets me excited because we talked about, and I always remember this, COVID and the accelerator to change, that forced people to use Zoom. And that transformed on how we do business. You didn't have to travel, meet in person. Still good to do it, but it's those accelerators to change and the early adapters to change. That is something that we key on, and you look for that going forward. That's an important part. Thanks, Tom.
Yeah. So Alex, I don't know if you have any follow on that as well or any thought.
Yeah, sure. I mean, the advancements, they even go beyond AI. So we have this portfolio company, Intuitive Surgical, that does robotic surgery, and we're now up to more than 20% of all surgeries in the US being robot assisted. That I'm fairly confident is going to 100 eventually. A robot is just going to make surgery better and safer. It's going to save lives. Autonomous vehicles are going to save tens of thousands of lives as they, reduce deaths from accidents, potentially even close to zero as the technology matures.
And my last point, though, I do want to mention when we talk about bankruptcies, even though that's not a positive topic, it is necessary in a free democracy. You have to be able to succeed, but you have to be able to fail as well. You can't support those companies that aren't making money. And again, in our country, that's what we should be doing, and that's what we do. So when you hear bankruptcies, I don't want people to get this just overall negative sentiment. You know, Bed Bath and Beyond, how long did that exist before? I think it still even exists. But there's, again, that's the evolution of the industry. Companies do well and you're changing. It's a big ship to move, and Walmart was able to successfully do it. And you have other companies that weren't, and they should be allowed to fail.
Let's talk a little bit about, some of the companies that we will be focusing on in the second half of the year. And I'm going to pick a sector that we don't have in the notes, and we're going to talk about the broad healthcare, biomedical, and biotech sector. I'm going to tee Joe up and also Alex up with this because we've been talking about the patent cliff, that's out there. And what is going to be the next step for some of these companies to maintain the strong revenue growth that, let's just say, a Merck has with Keytruda or a J&J has with a specific oncology drug, and then maybe Intuitive Surgical. What's next for them? Let's talk a little bit about the patent cliff and what to look for, and then I'm going to give some specific examples.
Yeah, so regarding J&J, a lot of reason that a few years ago investors were somewhat negative on it is their biggest drug was coming off patent. But what they were able to do is develop a subcutaneous version, which allows the patent to be extended for multiple years. And, from all reports, doctors prefer it, patients prefer it. So they were able to dodge the patent cliff entirely by developing this new administration mechanism.
Sure.
And for us, when we looked at Eli Lilly and talking about the GLP-1 or GLP drugs, that has been transformative. If that gets to a pill, it just saves the cost of administering it, the dosing of it. Those things are all very positive and transformative. We look at healthcare like billing, that's ripe for getting this much more efficient. So there's room for both of those when we look at, healthcare or pharmaceutical. That's not an area that we're heavily exposed to right now, other than the GLP drugs that are out there. But there is opportunity, again, with advancement as well.
Sure. And driving the earnings growth for some of these healthcare and pharma and biotech companies, and you have hope with some of the advancements that have been made. I mean, Intuitive Surgical is revolutionizing robotic surgery that maybe 20 years ago it was focused, mainly on urological procedures, but now it's expanded out there. There are now companies that have been innovated in the United States. I know of a North Carolina company that is making surgery faster, easier, and safer by reducing patient injuries, lowering costs, and not making kind of a mess or blunders out of dissections out there. These are companies that somebody like an Intuitive Surgical would look at to enhance and improve what they're doing for the patient experience, and also the insurance industry, the hospital. It's truly remarkable. Then you go into the oncology area where we're seeing incredible advancements in immunology, next generation cancer vaccine drugs that are being, you're seeing a lot of M&A activity right now in biotech. This is because there is that patent cliff out there for replacing drugs that are going to be coming off a patent. Very exciting times for that, and specifically the GLP sector. They're finding out that, and we've been talking about this on CNBC and Fox and Bloomberg recently. Joe's been excellent in getting this information out, but these GLP drugs are changing the way that we think about ourselves, not only addressing the obesity area, but the most important thing for diabetes, but it's also a different level for inflammation, for cardiac care, and improving our lifetime in general. So we will see, I think, that in the next several quarters, a lot of activity in that sector, which could once again drive earnings in a sector that's not being talked about. That's biotech and the healthcare sector.
And GLP drugs, I know this might even sound far-fetched, they could potentially alleviate the homelessness problem. And anybody who lives in LA knows there are essentially homeless people on drugs all around. Well, they're now seeing in early studies that GLP-1 could be positive for substance abuse addiction. And that would be, incredible for our quality of life here, especially in LA. So I'm very much hoping that indication is workable.
Yeah, that's good. We will, Joe, do you have any additional comments that we didn't get to that you kind of reminded yourself along the way that you want to cover?
No, I think we covered every topic there. Anyone have questions, feel free to reach out to us.
Okay, I'm not sure if we're allowed to take questions right now, but I think that what we'll do
Email
is,
us.
yeah, just email us and we'll be happy to get back to everybody. Um, we've enjoyed, the opportunity to get together with you all, and today, thank you very much for your time. We will distribute out the market outlook notes to everybody. The call is recorded, so if you want to listen to it, we'll probably have it up on our media gallery in the next day or two. We want to wish everybody a happy second half of the year. Enjoy getting out there and enjoying time with your family. And uh, uh, that's all I have. So take care, and we'll talk soon.
Thank you.